I'd now like to introduce our featured panelist, John Nicola. John Nicola is chairman and CEO of Nicola Wealth. He started the company 28 years ago. Since inception, Nicola has seen staff increase from 7 people up to 400, and also assets under management from 60 million up to 11.6 billion. So John Nicola has garnered numerous entrepreneurial growth and corporate culture awards, Ernst & Young Entrepreneur of the Year, Business in Vancouver's CEO of the Year, and most recently recognized as one of Canada's most admired CEOs, and also has a good sense of humor. So,
as long as you don't ask my wife, yes, okay.
Yeah, according to some people, not everyone. That's right. All right, so let's get started. So the focus is lessons on building a high growth company. So what's interesting is Nicola, of course, is in the business of wealth management, but I think in parallel, it's a great story of entrepreneurial growth. It itself, advises high growth companies and high growth business owners, but in fact, it's its own high growth story. So maybe you can start off by just sharing, why did you start the company?
Well, it's a really interesting question because, of course, our background would be very different, I think, from most of your members who probably were younger when they started their businesses. In 1994, when the business started, I was 42 years old, and I'd already been in the industry for 20 years. The last 10 years as an equal partner with Jim Rogers in a group called the Rogers Group, which is also a wealth management company. And I didn't really have any plans to change. I was pretty happy with the way things were working, making pretty good income. I own 40% of the shares of the company. I thought things were going quite well. My role was president, and he was the CEO of the company at the time. And about 6 months before our company started, he came to me and basically said that because of his nature, he felt he needed to go back to 51% control of the company, and he needed me to step back as president and go into a vice president role. And I didn't really I was very surprised by this. I didn't see it coming. But I basically said to Jim, I won't accept your terms, but what I will do is sell you all my shares, and I'll leave and I'll just start my own business. And that's what I did. So I'm older than most entrepreneurs, and I'm not intentionally going into it. A series of events occurred that said, okay, now I have to do, quote, my own thing. And interestingly, it took us about 6 years, from 94 to 2000, to actually build the model that has really become the company that we have today.
Well,
So
John,
it was not ever overnight success or even an overnight idea.
yeah, so that's quite interesting because a lot of our audience, of course, they're entrepreneurs, and there's the stereotype of an entrepreneur is usually young, maybe not that much experience, has some idea, and goes for it. But your situation, in fact, is statistically the more common one, to be, like you say, 42 years old and then starting an entrepreneurial venture. So now you mentioned you had a business model and you spent some time perfecting it. So maybe just explain to people, who aren't that familiar with the wealth management industry, what's unique?
Okay, so I see, I've always seen, but I see even today, a lot of flaws in the way wealth management, financial planning, asset management are actually done for individuals, families, households. And the first is that it doesn't really matter in most cases how big the organization is. You can be the largest bank in Canada, you could have 2,000 advisors working for you, but really what you have are 2,000 silos that are working under the umbrella, the custodial governance umbrella of the bank. And it's as if you've got 2,000 mini businesses. It would be like the equivalent of a real estate licensed realtor working at Remax. So basically, you're paying effectively a desk fee. And even though technically you're an employee of that bank, in reality, you're not really. And there's nothing in common between you and the other advisors. And that was what it was like at the Rogers Group. Everybody had their own clients, could, within reason, recommend what they thought were the right products. There was no cross-pollination and sharing of files or any of that stuff. So I looked at that and I thought, That's a flawed model if you really want to get the best result for the client. The second part of the model is flawed, and is still flawed, is that many, if not most advisors, are still receiving most of their compensation in the form of commission or trailer fees, as opposed to charging the client fees and finding wholesale pricing in the investment marketplace. And so that those two things, acting in a fiduciary capacity for the client and then acting in a collaborative fashion within your group, I think are the two things that we wanted different in our model and we were able to achieve. But to be fair, it took us about 6 years to get there because we inherited the old model when I left the Rogers Group, and we had to morph it into a new model. So 6 years into the model in 99, 2000, I literally asked one third of the company advisors that were there at the time, we'd grown to maybe 25 people, to leave because they were doing their own silo thing. I cut our real estate space that we were renting back by one third. And I said, we have to blow this up so we can start all over again and get it right.
Yeah, see, that's quite fascinating because a lot of times when people think of successful innovation, we often think of a high-tech product as opposed to innovation in the service sector. So with the process you described, what do you think would be a lesson on that you learned as to how innovation happens, how to implement a successful innovation?
Well, there's a lot of interesting ways that you could look at this, but there's a great book that came out a few years ago by Simon Sinek called The Infinite Game. And, he talks about a lot of things in there, and I really like Sinek's work. I think it's brilliant stuff. But he talks about three questions: why, what, and how. Why being, okay, what are we trying? Why do we want to do this? We want to enhance, the financial well-being of our clients and help them achieve the legacies that they want for their children, for their community, for their family, for what maybe in some cases their employees as well. So what are we trying to achieve? Well, generally it's a form of financial independence and outcomes, results, returns in relation to inflation and in relation to fees and costs. And there are outcomes that we want to achieve, outcomes that they want to be able to say, okay, can I understand the financial impact of giving money away to my children or giving money away to a charity? Will that challenge my financial security? And finally, the how. And the how part is where the innovation comes in. Because if I want you to invest in real estate because it's a good asset class, but the only way you can invest in real estate is to invest a minimum of $100,000, $500,000 and be an investor in one single building, then I haven't achieved my outcome. So I have to figure out a way that you can invest, let's say, $5,000 into a pool that itself has got maybe 100 buildings diversified across, let's say, an entire continent. And then now you're where you need to be, which is diversified in real estate. You have liquidity and you didn't have to put up $100,000 or $500,000. Mm-hmm. And we have managed to build a pool that is much less risk oriented because, of course, if you have one investment in one building, your risk factor is a multiple of what it is if you have an undivided interest in 50 buildings.
So one thing that strikes me as quite fascinating is, so the innovation you're talking about, was it something that people were asking for, as opposed to you thinking this is a better way to deliver a service?
It was more the latter than the former. Basically, what I took a look at is I said, okay, and I'm selfish. I'm looking at it from my own personal perspective. I'm saying, I think I should be investing in real estate. I take a look at people who very successfully invested in real estate. And then I take a look at the alternative, which are the publicly traded real estate investment trusts, looking at their returns and volatility and all of the other things. I think to myself, what I really want is a diversification of the real estate trusts with a reduced volatility and accountable returns of actually the direct ownership of the real estate. So as you look at the problem, you start to sequentially design this end game. And the first thing you do when you're doing something, and I tell all of the people that work for me, is I said, look, because they'll usually say, I'll say, we should do this. Now, when I say we should do this, what I'm describing a what. This is an outcome I think we should try to achieve. And inevitably, almost the first question out of anybody's mouth is, how? And I say, you know what? I don't care about how. I want us to really be clear about what we're trying to achieve. And then step by step, we're going to reverse engineer that until we figure out how to connect it to where we are today. So I'm not worrying about the how because in almost every situation I've been in, there is always a how. You just can't see it this instant. And
Mhm.
so that's what we try to get people to do, anchor themselves on the outcome they want, because then they're much more motivated to get to the how, because they really want to get this done.
So, how much of the growth of the company would you attribute to changing the mindset of the people who work at the organization? Like, in other words, what you're describing, was it a matter of just really working hard at establishing a certain culture mindset that was different than the industry? So you had to really invest in that? Would that be one of the keys to the growth?
Yeah, I mean, to be fair, in our case, again, the industry has a tendency to want to, and it doesn't really matter if you're a big insurance company or a big bank or even a small brokerage firm, you tend to go for, quote, the experienced advisor that's already got a set of clientele. And because, in theory, they're going to be profitable out of the gate. The problem is, of course, your ability to change somebody that's already been doing things a certain way for 20 years is
Mhm.
pretty small. So even though it takes longer, so if I bring in somebody that's going to become a financial planning assistant and then eventually an advisor, and basically I'm now looking at an apprentice model, I'm looking at an intern model. This is what law firms do. This is what accounting firms do. This is what hospitals do with residencies, right? And
Mhm.
obviously it works. So the only question would be, of course, if I bring somebody in who's 25 years old and out of university, maybe got a little bit of experience at a bank, they obviously, A, they don't have any clients. B, the clients they could get are not the profile of clients that we would want. So how does this work? So from the very beginning of our firm, we have focused less on marketing in the sense of prospecting and more on being referable. And I just said to people, look, do the best you can, do the absolute best job you can, go very high level in service, basically create a wow factor with the client. It's like a great restaurant. People are going to hear about it. They're going to talk about it. And you're going to get this call so that you don't have to go out and dig up business. You can simply respond to a new person coming to you and say, I hear you're handling my friend Bob's and Karen's affairs and they rave about you. So can we talk?
Mhm.
And today, that 75% is almost 90%.
Mhm.
So very, very little of our business is coming from what I call anything but unsolicited referrals, whether to our website or from centers of influence or existing clients, it doesn't matter. So that changes the framework. So that means I can bring in the youngest and the brightest and get them developed into really great advisors, and they will build and support our culture and our model. I don't have to re-educate somebody that may not want to change their ways.
Yeah. Well, I think this is a good time to segue into, I think, what's one of the key questions I wanted to ask you, and it's something you've spoken about in other places, but this concept of sharing the pie.
Mhm.
So maybe explain to our audience what that is and how that's been part of the growth of the company.
Well, let me go back to the example I started with where I was with this financial planning group in Vancouver before we started the firm, and I was partnered up with. So we had a little mini team within the group. So let's say the group was 50 people with staff and everybody else, and our mini group was about 8 to 10 people. And I was with a good friend of mine who's also with the firm, somebody that you know, Rick. His
Hmm.
name is Murray Nielsen, and Murray and I started working together. This is 1984. I'm talking about now, so this is a ways ago. And at the end of our first year, we decided to give a bonus to our staff. And we just calculated how well we had done, and like as if we were a mini business. And it was almost like a profit sharing, not exactly profit sharing, but it's like that. Anyway, the average pay of the staff at the time was probably around $20,000 a year. And we gave them a bonus of $2,000 or 10% of that. And then shortly thereafter, within a week of doing this, and it just happened to be before Christmas, we're getting all of this heat from all of the other partners and shareholders and advisors in the company saying, "Are you nuts? What are you doing?" I said, we're just get, you know, our staff appreciate this bonus. I mean, we're just giving them a bonus because they did great work and we've had a good
They,
year.
they probably suggested giving them a turkey.
Well, they actually said a Christmas hamper, to be fair, Rick, a
Okay.
$75 Christmas hamper. And I said, well, geez, if you're giving them a $75 Christmas hamper, then I'm not the problem. You are. And I said, that's even though we didn't call it share the pie at the time, that was the beginning of it. That was the embryonic aspect. So when we started the company, we immediately had profit sharing built in. Typically, it amounted to around 10% of somebody's annual income at the time. But as our margins got better over time, it's increased. So last year, for example, profit sharing amounted to 35% of every salaried staff person's base income. So basically, it's a very significant part of annual compensation. It's been not less than 25% for the last 8 or 10 years.
Well, John, if I can just stop you there for a second. When I've mentioned it to people that I know that the bonus for staff is 35%, it's almost unbelievable. Like, people find it's like very, very surprising, and they go, where can I apply? So
I know. But the
motivator.
weird part is this. Effectively, it's a zero cost game depending on how you view it. Okay. So let's say what I'm doing is I'm saying to people, okay, if I treat you like an owner, can you change my top and bottom line by 10%? And I'm talking about the entire company now. Okay. And I'm saying, well, unless I hired completely the wrong people, my guess is they're going to change it by at least 20%. So if I'm giving them 10% of our profits adjusted for return on capital, so it's around 9%, that's not an expense, it's an investment. And I choose to think of it exactly that way. It's an investment. And so whatever the profit sharing pool is, we have a return I can measure as a shareholder as a result of doing that. And so my mindset is not, wow, if I give something like that to all of my staff, I'm taking it away from myself. That's absolutely not the case.
Well, so just to emphasize that point for everyone listening, it's interesting because sometimes people describe it as scarcity versus abundance, or
Yeah.
they look at their expenses and say, well, if I'm giving out a bigger bonus, it's coming out of my pocket. But what you would say to entrepreneurs, business leaders listening is, it actually is an investment in people and an investment, I guess, in the growth of the company.
Well, and it's also a message. What you're saying to people coming on board is, okay, we have profit sharing. We've just made sure we have actually just recently modified it. We actually had a waiting period of 3 months to 6 months. And as it turns out, my son, who's our chief technology officer, made a proposal to the senior leadership team and said, look, if we're hiring the best and the brightest and we believe in them and they're going to make as much of a difference as they can from day one, why would we have any waiting period for profit sharing? And we thought about it and we said, well, I guess in hindsight, unless we made the mistake of hiring the wrong person, the bottom line is we have no reason to not include them from the beginning. So from now on, all people that were hired as of January 1st this year have no wait period. They don't have a wait period for profit sharing, and they don't have a wait period for benefits either.
Mm-hmm. So what you described relates to salaried staff. Now, the other part of the sharing of pie, which I think would be of a lot of interest to people, is your personal equity stake in the business and
Yeah,
how you've handled that in relation to the rest of the team. And because, again, some people may have been counseled, hold on to as much as you can. So what's
in
your
terms of shares, yeah. Well, I think that is a mindset that does actually occur. I think it's, again, my view is it's flawed, but again, I'm speaking as somebody who does financial planning and advising for a lot of self-employed people, some of whom are entrepreneurs, some of whom are incorporated professionals. The entrepreneurs themselves, the business owners, entrepreneurs, typically the one thing there's a tendency to do is to hold on to most or all of the shares. And then paradoxically, they'll come to somebody like me as their advisor when they're older and say, okay, well, I think it's time for me to, retire, leave the company, stuff like that. I have to put it on the market and sell. And I said, well, yes, you do, because obviously what you have is you have a situation where you've got all of these staff, they have no equity in the company, they can't buy the company, they can't transition the company, they're not owners. So you have to sell it to strangers, basically, well, either a competitor or a financial buyer. You're going to use an investment banker. You're going to pay them 5 to 10% commissions to do it. You're putting your staff at risk, and probably you have to take part of what you're going to receive in an earnout over a period of 5 years or 10 years. So that's the reality you created, because at no point while you were building the company did you consider that with some of your key people, that what you should do is allow them to get equity in the company, either by using options, which is what we have used, or by using shares, or some combination of these two things. Now, the reason I believe that I know that this works is because I started with 100%. I mean, it was just me. And now my wife and I have 47% of the shares of the company, and 60 other people have the other 53%. Now, the first thing that happens then is, by definition, those 60 people, who are generally younger than I am, have every reason in the world to want to continue the company after I retire, which means I've already got a built-in market to sell my shares if I want to. But more importantly, I don't actually have to sell the shares. I could just leave this as a long-term legacy asset for my company. So that option now exists as well. Okay. And so when I consider all of these factors, and the fact that when I take a look at the value of our shares today, we have a buy-sell agreement with a share repurchase arrangement and evaluation done every year. My shares and the dividends that I've received over the last 27, 28 years is 300 times what my 100% was worth at the beginning. So I've got a huge rate of return again, and in theory, I've been, quote, giving away shares, but I haven't given away shares. People earned options. They built equity in the options. They had to exercise the options, write a check, buy the shares. Now they're owners, real owners, because they've written real money, and they basically financed these shares, and they paid them off with the income and dividends from the company. So they have this great model, and trust me, this is important to them. This is maybe a material part of their net worth. It matters to them how well the company does.
Well, see, it's interesting because, of course, I've heard you say that previously, but every time I hear it, it always causes me to do a double take, because I just want to emphasize this point for people listening, that like you mentioned, you now have 47%, but that's worth 300 times what your 100% was worth a long time ago. So I think the value creation piece is critical. Secondly, this, of course, we deal with a lot of people undergoing succession transition, and what you describe is such a key issue for a lot of the people
Oh, yeah.
listening.
I mean, it would be nice. I mean, for a lot of people, if you think about, you build an organization. The fact is, most people who build an organization, at a minimum, have at least a number of their friends who are inside the company. Yeah, they have personal relationships. They've gone on vacations with them. They've gone to dinner and social events and stuff like that. And so there is kind of almost like this social obligation. So the way Simon Sinek would describe it is this: he would say, look, let's say I want to, quote, look after the shareholders of the company. And if you remember a very famous Milton Friedman's comment he made 40 years ago, he said, the only purpose of a business is to get a return for shareholders. Now, I remember when I first heard that, it bothered me. I couldn't exactly figure out why, because in theory, logically, it sounds like it makes sense. But Sinek really put it the right way. He said, okay, here's how the framework works in what he called the infinite game. So let's assume you put your clients or customers first. You put your staff second, including your colleagues and partners, okay? You put your community third. So this relates to philanthropy and charity and stuff like that. Your job is to achieve a great outcome for all three of those things. If you do that, the fourth item, which is shareholders, are going to be hugely rewarded by just focusing on the first three. The last thing the shareholders need to focus on, paradoxically, is shareholder return. They have to focus on the first three items, and they'll get the shareholder returns. And I believe that completely. And I think that most organizations, this is why, you think about cultural issues, like why do people want to join an organization? This comes down to the purpose of the organization. If you have these three things in mind, you have a purpose as an organization.
Yeah. Well, I think this is a great time to ask a question about the giving aspect of the company. So since I've been part of the company, I've been, I'd say, somewhere between astounded and impressed at the commitment to giving. So maybe just describe some of the things that company does, but then also like why, because a lot of companies don't practice what Nicola does.
Yeah, so it started on two fronts. Claire and I personally have always tried to be reasonably generous in terms of giving, but we didn't organize it into a private foundation until a number of years ago. But what we had done 25 years ago, shortly after the company started, is we created a public foundation within the company when we were very small, which would allow some of our clients to have what are called donor advised funds. And that was like a mini foundation that we would manage. They could make a deposit in, like a bit like an RSP, and the and it would be tax deductible. And then that account could then write a check to their favorite charities or organizations they wanted to support. And they could build a legacy account over time, which became, let's say, an endowment effect, if you will, a mini foundation, as I mentioned. And then ultimately, if it gets really big, um, they could move it into their own private foundation. So since we started that it's called PGF, Plan Giving Fund, and it's now $170 million of assets within the fund and managing the 350 different households within our company group. And we can see that growing a lot. So to a large degree, and we pay all the expenses related to PGF. So our clients pay nothing in terms of establishing an account or having it managed or having us write checks for them or any of the compliance. So that's our contribution to them being more generous philanthropically. And I think basically, since we tend to deal with wealthier people, high net worth or ultra high net worth clients, there's kind of a little bit of a moral obligation on the part of all of us to be able to say, okay, we can afford to help and contribute to our society, and we need to, and we're going to facilitate that. So we as a company created that for that reason. And then we ultimately, about 7 or 8 years ago, decided we needed to dedicate a certain percentage of our profits to a variety of local and global organizations. So we started. I proposed to the shareholders. I said, "Look, here's what I'd like us to do. I said, I'm not trying to do this overnight, but next year I'd like us to give a half of 1% of our profits to whatever organizations we'll create a charity group within the company and choose the organizations we want to support. And each year we'll go from a half of 1 to 1 to 1.5 to 2, and ultimately to 3%. And I said, think of it this way. You're the shareholders, so you have to approve this. But can you live on 97 cents on the dollar? Because I'm only asking for 3 cents, and I'm waiting 5 years to get there. So they all said, yeah. Nobody said anything against this. Well, this year, we're going to be able to distribute over $2 million to a variety of organizations with that 3%. Mm-hmm. And that means essentially that a lot of organizations in Vancouver, Union Gospel Mission and Canuck Place and Covenant House, and then overseas organizations, the International Justice Mission, Opportunity International, like just a lot of organizations where we do homework on them, and we have a charity committee of 9 people, all from within the company, and looking to do the due diligence on how to give money well. So to us, it is absolutely part of what we do and what our culture is. And a lot of people in the company are engaged in both time and in money in other organizations that way.
Well, I think there's a number of really critical things. So one is you're helping your clients be more effective givers, but then also the company itself is modeling giving through its own efforts, which I think is also really, really important. So now those are great things. Also, the other thing I picked up on is you didn't wait till you were this size to start giving. So what would you say to people who say, you know what, I don't quite have enough yet, but when I do, then I'm going to start?
Well, again, I think the problem is that people don't appreciate the fact that it's a mindset as opposed to an amount. So if I said to somebody, and I suppose maybe a lot of religions have really got their head around this and through the concept of tithing, and the idea is to say, okay, well, whatever you make, 10% should go to the church or to the temple, or to the synagogue, so that you're basically committing something that's you're still able to live in the 90%.
Hmm.
And the 10% supports, something that is an important aspect of your
Hmm.
life, your spirituality. So I think that's probably the solution. People can say, okay, fine, yes, I could give maybe 3%, 5%, 7% of my income to charity. That might not be a lot of money, but even if it was $1,000, the fact is your mindset is saying, I'm going to do something. So it's part of my habit, part of my makeup.
Yeah. I think it's a great way to to put it, to say, can you live on 97%?
Yeah.
That's a good way to put it. Well, one question I want to ask is, sometimes entrepreneurs look at someone else and think, wow, that's a great story. Went at a 45-degree angle, no blips along the way. But maybe can you describe, have there been like, has there been a mistake or what's been a major challenge where you've really had to go, wow, this is something we had to overcome?
Okay, so as I mentioned earlier, it took us 6 years to figure out how to build the platform. We had to go from mutual funds into what was called private counsel. We had to get licensing to be a portfolio manager. I had to go through my first year CFA in order to get approved by the BC Securities Commission. Like we had to jump through quite a few hoops, but we
Hmm.
did. And in 2000, we got approved as being a portfolio manager. And then that meant that we could recommend over a much wider universe of investment products and design investment products that we could never have done before. So that made a difference. It was a price to pay to get there, but you had to build the compliance and the other infrastructure to get there. I would say in two or three other times, obviously during the great financial crisis, obviously recently during COVID. And one of my best um, images, metaphors, if you want, comes from my early readings of Stephen Covey. Now I'm going back into the 70s here now. And Stephen Covey wrote about a lot of these habits, but one of them I really resonates with me is he said most people are focused on their circle of concern. In other words, these are the things that worry them. And you know what that's like. It's just like the weather worries them, okay, or the economy worries them, and that's their circle of concern. And then there's a much smaller circle inside that, which is their circle of influence, where they actually can make a difference
Hmm.
to the events that are occurring to them. And I've managed to teach myself the difference between those two things. 2008 financial crisis was in my circle of concern. There's nothing I'm going to do about how that unfolds.
Hmm.
What I'm going to do is say, where can I influence outcomes? So if a crisis occurred, what kind of portfolio would weather that really well? That's where the fixed income and the real estate and the private assets, along with the public assets, reduce the volatility. And in 2008, when the markets were down 40%, our clients were down, but they were down less than 7. When COVID hit and the stock markets dropped another 36%, our clients were down at the worst part of COVID in March of 2020 by 5%. So that's in our circle of influence. The circle of concern, which is COVID, is a problem. And maybe we can talk about it, but at the end of the day, we're not going to influence it. And
Yeah.
so separating these two issues and building a culture and saying, okay, where is this problem you just described? So if somebody is giving me a lot of noise about, I'm really worried about where interest rates are going to go, I'm going to say, okay, and what difference do we make to the Bank of Canada or the Fed?
Hmm.
So that would mean that we have no influence there. The question really is, isn't it? The real question is, what do we expect to see happen and what would we do in our portfolio? So in our case, if we think rising interest rates are statistically likely to happen, and we do actually think that, we
Hmm.
would say we're going to shorten the duration of our debt. We're not going to commit ourselves to 10, 20, 30-year debt. We're going to try to buy debt instruments that really roll over every 2 or 3 years. So therefore, rising interest rates would make them better, not worse.
Hmm.
And that means then that's our circle of influence. We control that.
Yeah. So we have about 20 minutes left, and I have a
Yeah,
few other questions here, but I think I'll start interweaving some
sure,
more
jump in.
investment related questions. So you referred to interest rates, and I had a question here. Now, of course, in Canada, we keep hearing noise that the Bank of Canada will raise rates over the coming year or so. But you started to give an explanation. But for people listening in, what are some general principles maybe to bear in mind, given that interest rates may be going up?
I would say there's no maybe about it. Interest rates are going up. They have been going up in terms of the open marketplace. So maybe what the listening audience needs to understand is this. Basically, there's two kinds of rates. There's the kind of rates that the central banks of countries control, and that's the bank rate, basically the one you hear about, and everybody's waiting for the Bank of Canada or the Fed or the Bank of England to make a decision about those rates. Then there's the bond market, and absent the central banks buying bonds in that market, essentially that market is controlled as a market. So, for instance, there was at the nadir, the lowest point, 10-year bonds in the U.S. were down to about 0.6 or 0.7% for 10-year bonds. Now they're at 1.9%. So they've already gone up 1.2% because the market is saying higher interest rates are inevitable. That means that the price of those bonds has gone down. So the price is inversely related to the yield that's on those bonds. You have to remember that if you looked at the last century, you could buy government bonds and they would pay you an interest rate not less than 2 to 3% above inflation. Now you've got 7% inflation in the US, you've got 4.5% inflation in Canada, you've got bond rates that are still below 2% for 10-year bonds. So statistically, what do you think is going to happen? So you have to assume you're going to see higher interest rates and or lower inflation. I would argue both are likely to occur. So the current inflation, I think, is, a lot of people are saying it's not transitory. I believe it is. I believe, in fact, that because of demographics and other major macro aspects of the global economy, we're not likely to have deflation, but we're going to have low inflation. Demographics is a big factor in the aging. People spend less money on consumer goods. They just do. So if you take a look at that, and if it ultimately we go back to the kind of the 2% inflation that we'd had for the last 20 years up until COVID, and you look at bond rates, they should be probably not less than 4% on 10-year bonds. And so that would be still double where they are now. So I think it would be incumbent on people that are using debt or managing debt to think about exactly how that debt is used and created in terms of their business. And if they're able to lock in, let's say, a long-term mortgage rate on their building that they own, that would be, I would think that would be a very prudent idea to do.
Yeah, that's a good segue into the other question I was going to ask, which relates to real estate. Now, of course, real estate is part of a core portfolio. So maybe just describe, especially because, in Canada, we have these crazy markets for residential properties in Vancouver, Toronto, major cities. So if someone's looking at this from an investment standpoint, and they have their $1 million or $1.5 million to invest, say, with Nicola, well, how does real estate fit into that, and what's the firm's sort of approach to acquiring real estate for portfolios?
Okay, so the first thing, we don't think of housing, which is actually the world's largest. If you look at all the real estate in the world, 2/3 of the value of the real estate in the world, which is about $100 trillion US, is actually housing. We don't think of housing as an investment asset class at all. So I know people buy condos or maybe buy a house, rent it out and stuff like that. And I think that's great. Obviously in Canada, in certain cities, that's worked out really well. I don't think it's worked out as well as what I call commercial investment grade assets. So that includes industrial, it includes multifamily residential. So like a larger building with 100, 200 suites that is a rental asset as opposed to a condo asset. You have obviously the retail marketplace, which has been hit significantly over the last two years, and then commercial office, and then subspecialty areas in groups like obviously farmland or mini storage or on the aggressive side hotels and stuff. So you have all of these sub asset classes, and if you look at REITs, you'd be able to find each of these sub asset classes would be in one or more REITs. Some are general purpose REITs that cover them all, and some of them are specialty REITs and they only deal with one sub asset class. So in our view, what we have to decide to get a better return for clients is, of all the sub asset classes, where do we want to focus our time and attention? Where do we want to minimize risk, get the best interest rates if we're getting financing? And our view is that we need to have a disproportionately higher focus on industrial and multifamily residential. This is the lowest risk areas, in our opinion, because of demand issues related to online shopping and transportation issues and housing issues, and we think have the best aspects. So if interest rates are going to rise, we want to have real estate that's got a reasonable chance for the rents to at least rise at or above inflation, if possible, over a period of time. Mm-hmm. So that's how we make a decision about where we focus on real estate. And then the second thing we do is we want to put it in a pool, a large pool. So our real estate pools now manage over $6 billion of real estate and to handle represent about 140 different properties throughout North America. So it means that our clients have as soon as they're investing, they're automatically diversified because they have an undivided interest in assets across 2 countries and in multiple geographic zones and in multiple asset classes. And so therefore they have lower risk, and both of these pools, the income pools, generate roughly about a 5% cash on cash income. Mm-hmm. So that means that they've got an immediate cash flow. If you're thinking about retirement, for example, $1 million is generating basically more than $4,000 a month of net rental income. Mm-hmm. So these are all aspects we look at when we're deciding how do we want to invest in real estate. And it's ongoing dynamics. It doesn't mean to say that retail will never come back. Mm-hmm. Retail might come back, but differently. So you can imagine somebody saying, that shopping center, like half the stores are closed in it. And somebody else might say, yes, but look at the location. So what if I redevelop that shopping center and make it 75% multifamily residential and 25% stores? Mm-hmm. Now it looks a lot better than it does now. Mm-hmm. And I've added some value to that result that creates a return in what otherwise might be a tough sector.
What's interesting with the company where it is today, so you mentioned, so the company manages about $6 billion in real estate and overall manages 11.6 billion.
Yes, so I should qualify that one. So the $6 billion is the gross value of the real estate. So the net equity value is roughly around $3.5 billion. So there's $3.5 billion of equity, $2.5 billion of debt. So the gross value of the real estate is $6 billion, but the $3.5 billion represents the net equity that our clients have in those assets.
So what I find interesting with the company is, could you describe, so when you started Nicola Wealth, did you have an idea as to the role of property? Was that a deliberate strategy, or was it something that as you kept working in the market, you saw this is an opportunity that I've seen come up that I'm now going to pursue?
It's interesting, I mean, because people have asked me in the past about, did we have the vision for building what we're building now, stuff like that. And if I'm really honest with myself, in '94, the short answer would be no. I mean, there's no way in '94 I thought, okay, well, we're, in 25 or 30 years, we'll have some $12 billion of assets under management. I could just see it now. Well, there's no way I could see it then, right? So my view basically is that essentially what we're doing from our perspective is to say, let's continue to build things. And let's say real estate, because a friend of mine who was in the property management business said to me, look, you can, I deal with property management. These clients have assets. We should invest in a building on our own, like just he and I. And I said, well, if we're going to do it ourselves, we should get some clients invested. And so we started literally like an investment club within our company. And we bought this very cheesy, very small strip mall in Victoria on the outskirts for $8 million with this property management group that helped run it for us. And we put in $3.2 million of equity, $100,000 each for 32 investors. And we said, okay, here we go. So that was the first investment asset we bought in 2000. And then a few years later, we tried it again in some assets and shopping centers in Calgary. And then we tried it with a couple of other assets, and pretty soon by 2000 and roughly 5, we had, let's say, 6 or 7 assets. And I said, you know what? Not all our clients can invest in these assets. Why don't we just get everybody that's in these assets to agree to move all of them into a pool, and they'd have this undivided interest in all of them. And then from then on, that pool will be doing all the buying, and
Mhm.
people will invest in the pool. And that's how it evolved. But what I'm trying to explain, Rick, is that it wasn't as if in 2000 we said, I can see where this is going. I can see each one of these steps, and I know exactly we're going to be in a pool in 6 years' time.
Mhm.
It wasn't that way. We evolved into that, okay?
Yeah.
We didn't plan that in that way. We just knew we wanted to include real estate in the equation.
Well, that's an interesting response because that's the classic entrepreneurial experience where, if you have an innovation mindset, you're looking for opportunities, responding to what comes up. And of course, what people may have thought in 1994 is not specifically where they end up 28 years later. Hey, I have a question related to the U.S. market because I have a
Sure, yeah.
friend from Los Angeles who contacted me. So it's interesting so from the Canadian standpoint, we might look at the US market and go, wow, it seems like there's a lot of problems down there in terms of debt management and all these challenges in Congress and with approval of bills and all these things. But from your standpoint as an investor, how do you treat the US market in terms of, buying property, putting your foot in that marketplace?
Well, I think again, um, people talk about real estate being always about location. So again, coming back to the core issues of sub-asset classes. So in the U.S. in particular, our main focus has been multifamily, residential, and industrial. And I would say in the U.S., even more than Canada, those assets are probably 85% of the assets that we have in the
Mm,
US. And so then you tend to take a look and say, okay, where are the areas where you're getting, say, population growth, a change in density, or you have above average economic incomes or household incomes?
mm,
You're looking for all of the factors that are creating, let's say, the opportunity to do better than average. So if you think of the US as being effectively Europe, you wouldn't have, let's say, this concept of a European strategy. If you're going to buy real estate, there's a big difference in buying the real estate in London than in buying it in Dresden.
mm,
Okay, so it's like there are two different kinds of environments that you have to think about. So we focus on areas that we think are going to have good demographic growth. So the American Southwest, in particular, the Pacific Northwest, and the American Southeast. And so those areas and other areas, not so much. You know the hinterland of the U.S. Where are we putting a lot of money into states like Illinois and Ohio and places like that? No, the short answer is no, we're not, and not even in places like New York State and in California, for instance. Our focal point would be again in areas where there still is an attraction of people to a cluster. So, for instance, LA, San Francisco are possible outcomes, but maybe not as attractive as Seattle and Portland from our perspective. So,
mhm.
all of these are factors before you start to then look at the details of what opportunities exist. And finally, in this environment where real estate's had a pretty good run for better part, more than a decade, um, it's going to be even more important going forward to find assets where you can add value. In other words, you can't just buy an asset, lock it away, and turnkey it, and just to hope you're going to get a 10% a year net return over a decade. You're going to need to make some contribution to that asset. You're going to change the the tenant structure, or the change the density of the how the land is being used, or upgrade the building in some way, shape, or form to get a better kind of tenant. So that's adding value, and we're pretty good at adding value when we see it. So we want to be sure that the asset has the potential. And finally, the last area that we're doing more and more of, about 20% of our assets in Canada now, are what are called built to own.
Mm.
So rather than buying an apartment building that's already 50 or 60 years old, so that's going to need a lot of capex and expense and stuff like that, better for us to find something whereby we can build a brand new multifamily residential asset with the best technology, the highest degree of energy efficiency, and obviously a very low capex requirement. and
Mhm.
build that as a long-term legacy asset that we're going to hold for, let's say, in theory, 40 or 50 years. So
Mhm.
I think we recognize that there's no such thing as saying you should invest in real estate by itself. That statement doesn't mean anything.
Mhm.
It's
So
now the devil's in the details in terms of how you decide to do that.
yeah. So what I find very interesting is what you're effectively describing is this process of ongoing innovation. So let's say there's the what you're striving for in terms of returns for investors, but how you go about that keeps evolving. So again, going from maybe not having much real estate to having a big focus on real estate to now doing build to own. So just as we're wrapping up here, what could you say about like what's the key to success for Nicola Wealth? Is it this entrepreneurial, like how would you describe innovation and entrepreneurial culture? Because it seems that you need the mindset to keep seizing the opportunities as the environment changes.
Well, I mean, I think, Rick, if you think about what is our basic premise as a company. So if somebody comes to us, they're a business owner, and let's say they've got a certain amount of wealth, maybe most of it's tied up in the business. So there's the issue of the balance of liquidity in the business versus what they have as independent capital external to the business, their family obligations. So there's a bunch of things they need. Number one, they want to have somebody who can deal with sophisticated, advanced levels of financial planning, tax, estate, and all the rest of that. So we need to make sure we have all the competencies in that area, and we do. And then we say, okay, and then they need to have a diversified portfolio, specifically diversified away from the very business they have most of their wealth tied up in. So that means that we want their wealth managed by us to be like an insurance policy against something going wrong with that business, because it
Mhm.
can be. So therefore, it needs a different framework, a different liquidity in order to be supportive of what they're doing in the business. And then ultimately, when they do have a liquidity event, making sure that that results in, let's say, a tax efficient distribution of assets as a result of the exchange of the business for cash, and then ultimately a portfolio that's going to generate the cash flow to maintain their lifestyle and achieve their other legacies, whether they're gifts to children or gifts to charity and stuff like that. So everything is constantly changing and evolving for each of our clients. Everything that we do is bespoke
Right.
because each person's situation changes as constantly. The personalities are different, the families are different, the businesses are different. So
Mhm.
what our culture has to do is recognize that every time we sit down with a client, we're talking a brand new story. And
Right.
that story itself isn't staying the same. It's evolving over time.
Yeah, we've got time for a couple of questions, but there was one
Sure, far
question that
away.
came in, and it was interesting. It's about the minimum. So, why? What is the client AUM minimum? Why is it at that point, and has it changed over time?
Yeah, so our minimum portfolio has been really, it's been ever since 2000. It's been $1 million, and the main reason at the time we did that, and this is still true, is that we wanted to be in a very diverse portfolio. So we wanted them to be in the real estate, we wanted them to be in the other things. So we recognized though that there was another kind of client that we were coming across. The Interestingly, the young entrepreneur starting up a business, but also the young professional starting
Hmm.
up a practice. It's the same thing. And they
Hmm.
were the profile client that we wanted to have over the long term, but they didn't have $1 million to give us to start with because they're starting a practice or a business and they're starting a family and looking at buying a house. There's a lot of things on the plate. So we said, yes, but they're going to be a profile client for us.
Hmm.
So we made this exception for them and we call them future profile clients. And so we have actually quite a few hundred households in that category. And
Hmm.
their minimums are below $1 million and they're based on the circumstances that they're in at the time. We also created a pool to allow those kind of clients to invest in
Hmm.
everything everybody else does, but
Hmm.
with a one decision fund. So we created something called our core portfolio, which has an undivided interest in everything that we do. And I'm a part of the committee that decides what that mix needs to be in that core
Hmm.
portfolio.
Hmm.
They That portfolio, which we originally just did to help with the smaller accounts, is now $1.4 billion. It's the largest pool that we manage. It's
Hmm.
incredibly popular. And it's more than 10% of our total assets under management. So for somebody coming in and they've got $200,000 of assets for their future profile, we would use that core portfolio because they would get the experience and the outcomes
Mm.
a much larger investor would get.
Yeah. Well, that's great. Well, it's 12:59, which means I'm proud to say we're exactly on time.
Okay, perfect.
So
Well,
we
thanks, Rick. This was fun.
Yeah, so to everybody listening, I mean, thanks a lot for being part of this. Thanks for the questions that were submitted. And of course, if you'd like further information on Nicola Wealth, you can contact myself or John. Obviously, there's a lot of information on the website. And after we sign off, there'll be a survey, so you can sign up there for more information. Got a lot of great resources on the website and via our newsletters. So at this point, thanks a lot for being part of it, and have a good rest of the day and enjoy the rest of Hawaii.
Great. Thanks, Rick. Take care. Bye now.